Distinguished panelists, ladies and gentlemen, good morning. Thank you for joining us today for our second public panel of the Next Gen ESG Investing Program. First of all, I would like to thank our sponsors, ERISEC Partners, Star Magnolia Capital, Archipelago Capital Partners, and Vertex Ventures for graciously supporting our program. The Next Gen ESG Investing Program aims to identify, empower, and inspire the next generation of sustainable investors. All classes are delivered by leading industry professionals and is designed to support preparation for the CFA Institute certificate in ESG investing. We also provide real capital for our members to put their learnings into practice and generate their investment track record. If you are interested to learn more, you may check out our website at www.genzgroup.org. So without further ado, we shall start the panel. Should private equity firms embrace a proactive approach to ESG? Please note that this panel is for information purposes only. It does not constitute any investment advice. Audience, please feel free to submit your questions via Q&A anytime during the panel discussion, and we will address them wherever we can. I will now pass the mic to our moderator today, Mr. Shinya Deguchi. Shinya, please.
Great, Tiffany, thank you very much for the intro. Nice meeting you, everyone. Thank you for joining our panel discussion sessions on Sunday morning. That's very impressive, and then it shows your dedication for this exciting topic, ESG in private equity space. Today we have our friends, Mr. Jovasky Pan from Archipelago, and then Mr. Michael Fernandez from LeapFrog Investments. My name is Shinya Deguchi. I am co-founder and a special advisor of Generation Z Investment Club, and we are very happy to host this year this new Next Gen ESG Investment Program. So at the very beginning of this panel discussion, I would like to ask the two panelists their backgrounds, their views on ESG, and how you incorporate ESG factors into your investment strategies, and then just a little bit, especially on the micro size, what is impact investments, and then how you see the difference between ESG investing. So maybe let's start the introduction with Joe, and then after that maybe we can ask Michael.
Hi, thank you, Shinya. My name is Joe, and I am a partner at Archipelago Capital. Archipelago Capital is a private equity firm. We specialize in buyouts in Southeast Asia, doing majority control deals in 3 sectors. We focus on financial services. We focus on consumer goods and services, both discretionary and essentials. And we focus on niche industrials. We invest primarily in 4 markets in Southeast Asia, which are the Philippines, Indonesia, Malaysia, and Thailand. Right. Before starting Archipelago, I was previously at McKinsey, focusing on financial services, and then subsequently 11 years at Temasek Holdings, heading their commercial banking, investments, and operations. So very happy to meet everyone here today.
Thank you, Joe.
Yeah.
Michael?
Should I go? Yeah. Michael Fernandez, partner at LeapFrog Investments. LeapFrog is a impact investing private equity fund. So we have a specific requirement that all our investments have a impact deliverable in addition to commercial returns. But we are a standard private equity fund in the sense that we need to target commercial returns, and we raise money from other commercial investors. We focus on 2 sectors, financial services and healthcare, really with the intention of creating what we call safety nets and springboards for emerging consumers in emerging markets. So this is sort of the population in markets like Indonesia, Philippines, Vietnam, India, Bangladesh, Sri Lanka here in Asia, as well as we also work in markets across sub-Saharan Africa, Kenya, Ghana, South Africa, Nigeria being key, where what we're trying to create basic insurance products and access to credit, which allows emerging consumers who are beginning to benefit from some of the GDP momentum to secure their position and keep building and moving up in terms of income. Right? Prior joining LeapFrog, I was with Khazana. So in fact, both Joe and I from different sovereign funds, and then prior that also McKinsey. So similar backgrounds and quite a bit of overlap in life.
Great, John Michael, thank you very much for the introduction, and then we're very impressed by your extensive experiences in the private equity space. Maybe as the first questions, there's a lot of confusions among the market participants as well. What is the difference between ESG investing and impact investing? So maybe Michael, LeapFrog is primarily focusing on impact investing. What is impact investing?
Sure. Let me try to give an answer to that. And there's variations, of course, across this thesis. In my mind, ESG investing is a core set of principles to ensure that when you are investing and running a business, you're doing no harm, right? So you are a good steward of the economy. You're not discriminating against customers. You're not discriminating against vendors. You're not discriminating against employees. Equal opportunity employer. The business is run with clarity on governance. The audit processes are solid. There's appropriate independence in terms of decision making. So there's a whole set of principles there, which effectively are, I'm running my business in a way which is responsible to stakeholders and to society, and not just maximizing profit, right? So the core thing of a business is it needs to be commercially viable. That remains the core aspect of a business, but doing it in a way which is responsible to society and appropriately bearing the costs it needs to bear. Impact investing actually it's at the same level as for an investor. As you need to be commercially viable, you need to have a positive impact on a specific area, and different impact investors have different mandates, and some of them will have multi-mandates. So our concept of impact investing, the positive impact, is to ensure essential products and services to emerging consumers. Right? And there's a very clear theory of change around that, which is if by investing in these specific types of companies, we're able to enable insurance access, for example, micro insurance access, micro health insurance access, or life insurance access to consumers at the bottom of what is often the income pyramid. And very often they don't have products or appropriate products to help them. Then in situations where bad things happen to them, and let's be clear, bad things happen to emerging consumers all the time, their livelihood and their family position is ensured. What we have seen is a number of emerging consumers fall back into poverty, typically when either there's a major health event or a loss or disability to the major wage earner, and then offering them a minor insurance product helps create some buffer to that fall, ensures the family doesn't fall back into poverty. Children can complete their education, the family can pay its debts, for example, and continues to move on. Right, so trying to create that safety net, because very often governments are not able to create those safety nets for these countries. Similarly, offering access to a home loan product for a person who doesn't have strong credit history allows him to create an asset and a base for moving the family forward. Right, so looking at products which actually help solve the essential needs of emerging consumers, and that's then a positive requirement. Every company we invest in has to be commercially viable, has to do things in an ESG compatible way. They can't break the rules simply because they're having a positive impact, and needs to have a second level of impact, a positive impact on a specific topic. Right? So topic or topics. So that's sort of the way we think about impact investing.
Got it. That's very clear. So now, Joe, how do you, in your view, what's the difference between ESG investing and impact investing based on the definition or maybe the approach that Michael just shared?
So I think Michael was being very clear in that, right? I think ultimately, as I shared with some of you this morning, investing ultimately is about having a view of the future, right? Because you're not investing only now. You're investing because you believe that in 3, 5, 7 years, how is the world going to look like, right? I mean, who are going to buy your products? How will labor relations be like? How will women be treated? What levels of carbon regulations there are going to be whatsoever? I mean, you need to have a view of the future, right? And I think ESG investing at the very basic level is meeting a certain set of standards. Do no evil, as Michael said, I mean, do no evil, but at the same time, meeting a certain set of standards that are particular to what the current standards are, right? But I think that, firms that do good ESG investing try to go a little bit above those standards, right? How should companies behave to not only be a do no evil responsible citizen, but try to advance society in a way that you expect society will be advanced, right? I think impact investing is going beyond standards, but investing along certain themes, right, that you think the world should be moved forward, right? Do you believe, for example, in financial inclusion, right? If you do believe in financial inclusion, but you believe that a $5 account, a $10 account will never be profitable, right? It's very hard to invest for commercial returns. But if you do believe that the digital world and the lowering of costs of communications whatsoever will ultimately, over time, lead to financial inclusion being a not only viable, but profitable, and it furthers the ethics of what you truly believe in your worldview, then I think you have moved beyond that as a theme, right? People invest in impact based on certain criteria, right? I mean, you have everything more on the environment side, where you have clean energy, smart cities. On the social side, you have financial inclusion, healthcare, empowerment of women. I mean, there are certain themes and certain impact goals that allows you to choose your investment thesis. And I think that is the main difference between ESG and impact investing. Right? One is meeting a certain set of standards and advancing those standards. The other is primarily investing in a certain worldview where you believe that the world can and should be moved towards.
Got it. Yeah. Well, Joe, thank you very much. And then I think all the audience is very clear about the difference between ESG and impact investments. But then at the end of the day, I think what's most important is this, the companies and businesses, making positive impacts. At the same time, they can be profitable and then sustainable. And then I think that's the, what's in the common bottom of impact investing and then ESG investing. But then in the emerging markets, I think this, the concept of ESG and impact investing is relatively new. Maybe because the people do not believe that they're doing the good things and then making money can come together. And I know both of you disagree, but then can you elaborate your views on, yes, we can actually generate sustainable returns by focusing on the businesses making a positive impact?
In emerging markets, I mean, these concepts are still new, but I think everybody recognizes that even in emerging markets, regulation and society and all that is viewing the future in a certain way, right? I mean, nobody thinks that the old habits of throwing chemical waste into the rivers is not going to be regulated, right? I don't think that anybody truly believes that, you know, we will go back to the days where women are not allowed to go back to work, right? I don't think, even in emerging markets, yes, I mean, some of these developments are still new, but the direction that they're heading towards is actually very clear, right? So there are, and having a universal set of principles, right? No matter which market you work in. I mean, some of the carbon emissions, some of the levels of pay and all that across these markets are a bit different, but having a certain level of standard, right? About equality of pay, fair treatment of customers, whatsoever, has got to be in the ways that we incorporate our investment philosophies, right? And I mean, in emerging markets, you do face challenges in meeting some of these ESG principles, right? I can tell you for sure. Let me give you an example: petty corruption, right? In some of these markets, your guys come to you and say, hey, if you don't pay this guy, this thing doesn't get done, right? If you don't pay this guys, we will not get a permit. If this, you know, what do you do then? Because that has been the practice for so many years. So once you buy this company, some of these practices are still there. So what do you deal with? How do you deal with it? So the way we deal with it in Archipelago is, first of all, try not to get yourself into these situations in the first place, right? Don't invest in sectors that are clearly corruption is a way of life. And if you don't embark on these policies, there's just no way to do business. For example, things like mining, things like, you know, businesses that has to do a lot of land acquisition, right? Things like, you know, certain government related kind of power generation type of things where you got to clear land, and then, you know, and that is actually the business model, right? So I mean, the way that we selected financial services, because that's where at a certain level that is still kept very clean, right? When we have faced situations where they tell us that, oh, you know, if you don't pay these guys are not going to approve the installation of our gas steamer to the grid and all that. And the way we deal with this situation is we don't pay, because that is the standard we believe in. But the fact is that we are able to be in this markets is because we know we can solve problems in other ways, right? We will find government officials that we know or powerful partners that we have to clear this type of situations for us, such that people dare not touch us. And sometimes you just have to incorporate that, you know, a longer branch opening process and just build that into your business plans, right? But if you truly do believe in it, you just have to understand that there can be some costs and there can be some consequences, and factor that into your program, because you must truly believe it's worth it.
Got it. So the first of all, avoiding the dangerous sectors, or maybe the corrupt sectors, I think that's one of the important approach. Then maybe you can later on, if you find it, maybe you can fix it, and then you have to fix it. Got it.
Yeah,
that's very clear. I want to come back to this financial sector later on, but then Michael, do you have any the views on the impact investing in emerging markets? Is there any challenges have you faced in the past?
No, absolutely. It's not to stay focused on dual mandate is always difficult over time, over cycles. We've had situations, for example, where insurance products get designed in a way not to pay out to customers. right? I mean, there was a classic example of that, I remember, in the Philippines, where they would offer a insurance product to their migrant workers, right? Local insurance product. But the insurance, so if something happened typically to the migrant worker in the Gulf, he would get sent home, right? Nearly instantly. And now the guy is back home, and then the insurance company would require him to get documents, which they only give to him after he comes back home, which require to be stamped from where he's come from, right? Now this guy's come back home. He's not going back. He can't go back. He has just no ability to go and get those documents. And the day before, electronic documents, physical papers, stamps, whatever were required, basically meant he couldn't claim, right? So he had an illness. He was sent back home. And structurally, he could not claim against that illness, right? They didn't give him the documents up front. They didn't ensure that that process was being managed, right? And then when you work with these companies, and actually, and the reality is, we very quickly find, and entrepreneurs we work with find, consumers see through this, and over time, governments see through this, right? So a lot of those companies then get banned over time. 3 years, never paid any claims. A lot of migrant workers very unhappy, protesting, high embarrassment. This entrepreneur has made a little bit of money. He's made that 3 years profit, and then he shuts down and goes off somewhere else, right? And you've got to be very careful when we invest in these companies to make sure we're actually investing in quality businesses who are looking for quality outcomes, and not businesses who are trying to rip off the poor, because that is always a problem. Ripping off the poor has surprisingly been a constant activity in industry globally. Right? It's the easiest group to rip off of. They're the most vulnerable. So working through those sort of issues. I think the mix of women in companies, right? So we do require and expect our companies to be equal opportunity, but in a number of situations, they either for social constructs or other constructs may struggle to do so. Microfinance industries in India especially have had a challenge in having large women sales teams, because the nature of the job is you need to go and visit separate villages. You typically go on a motorbike, and riding around Indian villages on a motorbike is not something women do, right? So in urban centers it's possible, but as soon as you're going into rural markets, it's not possible. And in some of those situations, one accepts it and then slowly tries to move the company and the group forward, right? But you've also got to live within what's acceptable social norms of that market. So then try to ensure that the women are at the branches, right? So then they actually have, you begin to create a mix, you create the right ecosystem infrastructure around that. And what often happens when you solve these issues, even corruption, right? When you sort of draw the line over time, companies actually benefit. When we've seen that across markets, companies which refuse to pay petty bribes run into hurdles for some time. And then at some stage, they actually get fast-tracked, because the guy's like, why am I wasting my time holding back this guy? He's just not going to give it to me anyway, right? It's just not going to happen. And he's going to bring someone who's going to shout at me. So let me just get rid of these files and focus on the files where I'm going to earn my money. So you begin to see, once a company has a reputation for that, life actually begins to become easier. But it's very easy, the simplest thing for middle management to say, listen, I've got to give this guy some money just to make life faster, right? Versus going the hard path. So it takes time to build that muscle, to build that discipline in companies. But once that muscle and discipline is built, they actually benefit much more. Their reputation improves. I mean, middle managers don't want to be in jobs where they're paying bribes to people, right? So they're actually joining a company where they don't have that problem. It's actually better for talent over time, right? And once you're in a job where you're paying bribes to someone and you're doing something illegal, the likelihood you'll do something else illegal is also moving up. Right? It's just that path has been set, and that other illegal thing may not be about getting something done for the company. Maybe it was something getting done for yourself, right? So it begins to create a very vicious circle there. So companies over time benefit. But I do think the key is the upfront screening, right? I mean, for us, the choice is made when you invest. Is this a partner whom we work with? And is this an industry when you work with, you think you can manage these issues? And I think over time that will cause a structural change, as capital does not go into spaces which are dirty or problematic, over time, those spaces will begin to change to attract the capital. So I think, and these are slow processes, but over time, those processes do work.
Right. So upfront due diligence and then the research actually paid off, for the future, the returns and then avoiding problems.
Absolutely.
Just want to go back to this, the insurance, the business in Philippines, and then that was actually I found it really interesting. How did your company solve this issue eventually, or how you help, or maybe LeapFrog helped them to solve this, the issues of identifications? Is it because
the thing is actually quite straightforward, because what you need to do is invest a bit more in education, both in the receiving country and in the host country, right? So both in Philippines and then wherever they're going to, that if you have a problem, here's what you need to do, right? And actually have a very simple policy structure. So this gets linked to one of our remittance businesses and another one of our digital insurance businesses. Very simple product details. If you get sick and you have to come back home before you leave, here are the 3 things you get done. Right? And very simple lines there, so that immediately, once that happens. And 2 is then offer facilitation back home. So you come back home, you don't have the document, right? That the company can say, okay, fine, we'll take your claim. And, because all people who are going and migrant workers are often going through larger agent structures, etc. We'll ensure that you get that arranged. We can get that arranged for you, right? So we can provide a bit of that. But the core is actually the upfront. Train, when you sell the insurance, very clear checklist. Here's what you need to do: 1, 2, 3. So that when you come back, you actually have papers. You do need papers. I mean, it's impossible for insurance just to be handed out. Oh, I was sick there, I came back home, now pay me. It's never going to work, right? So you do need some papers, but just make that much more transparent, easier to access. So it's not that you come back home and suddenly realize your insurance claim is not going to get paid out when you don't have papers. I mean, to be honest, it's a bit like travel insurance, even for us, right? As I've lost my suitcase, and when I sort of go back and ask for a claim, they're like, okay, where's all your invoices? I'm like, what the hell? Yeah, I have clothes. I've been buying these clothes for the last 10 years. What invoices? Who the hell keeps invoices? I have no invoices for what I have in my suitcase. I have a suitcase, right? But what's inside the suitcase? You want invoices? I'm not going to give you any invoices. I'm not stacking hundreds of invoices for you. That happens even to us. But I can take it, right? Okay, fine. I think for the lower income person, they really depend upon this. If they lose that, it's a big problem. It's a big problem.
Yeah. Well, my personal experience this week was I withdrew cash in Shanghai for the first time in 1 year because the China became cashless, and then I completely forgot that I have to get a credit card, maybe the ATM card back from ATM machine after getting a cash. Yeah, and then I have to call my bank, and then they told them I have to cancel my credit cards, and then they asked me, so what is your credit card numbers? And I don't know the credit card number because I don't have the documents right now. And then I just realized, okay, I have to educate myself. I should have wrote down all the the credit card information.
All that,
it would make my life easier. So education is very important. But then I think for many insurance companies, it's better for them not to educate customers so they don't have to pay. But then I think the companies, the LeapFrog, invested and helping is really making a lot of efforts, and then education is a cost for the companies at the very beginning, right? And then but then it's quite impressive that they're spending a lot of they're making a lot of efforts to educate their customers so that they can actually create a much better long-lasting ecosystem. So going back to Joe, you have a lot of experiences in financial industry as well, and then you are helping a lot of banks, especially the targeting underprivileged borrowers as well. Can you share a little bit your experience, and then how do you kind of ensure the business is sustainable from maybe from a ESG perspectives, and then how if you have any specific the efforts you made to improve their activities?
Yeah. I spent my lifetime in financial services, right? And I used to run the biggest rural bank in China. I mean, we built it from scratch and all that. And right now, I mean, we invest in rural bank in the Philippines. You know, we have a consumer finance company in Indonesia, and I mean, I used to run a bank in Indonesia that focuses on SMEs and all. So we have seen the wave, right? And frankly, I think when a lot of people think about financial services, especially in emerging markets like Southeast Asia and all that, it is a huge opportunity. I mean, focusing on ESG, financial inclusion, it's a huge opportunity. You have what, 31% of people in the Philippines have bank accounts, 36% of people in Indonesia have bank accounts. And, you know, so it's actually a big growth opportunity, but the conduct is very important as well. When we talk about ESG principles in financial services, we try to go beyond the check boxes, right? Check boxes is, you know, or are you doing predatory lending? Is the interest rates too high? When you collect, do you send men with big sticks, right, out to do collections and all that? Those are really the basic. That is something that you should never do, right, for reputation risk. But we try to elevate it one step further, just because we have a lot of experience in this, to understand whether the financial products that we give, are they creating a better future for the customer or better future for the community? Because if it does, then it becomes a virtuous cycle, because these customers are often very, very sticky, right? Let me give you an example, right? Things like, you know, in Philippines, when people think about microfinance, right, they think about very short-term loans, right? You know, 2-week loan, 4-week loans, maximum 2-month loans and all that. Typically, you know, given to women, typically of a very small value, like say $30, $50 and all that. Fundamentally, players like card and all that follows the Grameen model, right? You know, peer-to-peer, they vouch for each other, whatsoever, right? So, but for us, we find that product design, besides tiding somebody over emergencies, actually don't really help the community. It's very simple, because for a business to grow, right, it needs both, not only that, but it needs equity. If you give somebody a 1-month loan, a 2-month loan, and the guy pays you back, right, within 1 month, 2 months, the guy hardly gets the chance to build any equity in his business, because just by paying you back the interest rate and the principal, I mean, that's the entire profits of his business, right? So what we create is that we typically target customers that can build growth and equity in their business, and we give them 24 months loans, and they pay back in equal installments, so that every month he's able to make surplus profit after paying you back that installment. We actually have a map that calculates out industry by industry, class by class, size by size, right? How much excess profit the customer will make after paying back the loan installment. And we track that. And it's a very important part of our credit scorecard. So that at the end of the loan cycle, he actually builds enough equity in his business for working capital, that the next loan that he comes to you is for growth. He's growing his business. We don't do another working capital loan again, right? So, I mean, it's very important to design the business, the products and the business model really about financial inclusion and growth, rather than just saying, oh, because I'm lending to the poor, I'm doing financial inclusion. That's not really true.
Got it. So it's lending, but then the lending money not to survive, but lending money to grow and then have a life. And then,
because there are people, Shinya, that frankly, that doesn't help them, right? They need either aid, right? They need the government or the community to step in with aid, frankly, right? Or they just need startup equity, which is another thing altogether, right? But you know, that is really to help them build equity in their business. So you have to say that you really can't help the world. It cannot be at this level, right? It has got to be at a certain level that is really untapped, that the commercial banks don't want, but at the same time, right, you know, it's they wouldn't get enough loan in the business from the borrowing from friends and relatives, right? Friends and relatives can't clobber together $2,000 to lend them.
I see. I see.
Mm.
Wow, that's very interesting. Just want to move the next topic. It's also coming from the audience as well. But then it was actually one of the questions. How do you measure the impact of your efforts? And then yes, you can actually screen and the good companies you can invest. But then in terms of success, how do you measure?
Sure.
Maybe start with Michael.
Sure. No, so again, because when you move into impact investing, right, you are actually setting a very specific mandate. So for us, it's financial inclusion and access to quality health for emerging consumers, right? So that's effectively what we're measuring for each of our portfolio companies. How many emerging consumers are they reaching? So, so there's an overall set of consumers, and then we use certain income categorizations and others to determine how many of these are emerging and how many products are they being able to access, right? And basically track that on a constant basis across our portfolio over time. Similarly for health, how many emerging consumers are being reached by this product set? So again, excluding the higher income populations. Although for the company, they may well have a mix of consumers. Our focus is in the tracking of this impact metric is how many emerging consumers are being reached, how has that been growing over time, and and that movement of that is important. And then we back that up by ensuring that these are being reached. That's where the ESG and the impact go hand in hand. We're reaching emerging consumers and we are following the ESG protocols guidance. So making sure, therefore, we're reaching them well. We're not reaching them and cheating them. We're not destroying the environment in trying to reach them, etc. We're reaching them well, right? So we're following appropriate protocols to reach them. And as we move across different sectors, we've had to keep thinking about, are there different metrics around what is, because the reach is it's a simple metric, everyone can understand it, but it's a very basic metric. And then over time, we add next level of sophistication to the metric, which is what percentage are we meeting with, in a way, what I'd call the full stack. Right. So the full stack of financial services is you need to have some access to payments, you need to have access to a savings account, you need to have access to loans, and even loans are of different types, small microfinance loans and a few loans which can actually help you build secure assets, either for your business or for your house and family, education, support, access to insurance, right? So there's a full stack of financial services products. Then over time we begin. The second stage is then saying, okay, to what extent are we helping people access the full stack, right? Now, if someone gets access to a bank account and a credit history, they may not get the rest of the stack from us. So we take, we got to look about those, some of the activities. If you have access to quality low-income insurance, it's actually easier to get yourself a home loan, right? Because then the lender is willing to give you a loan saying that, okay, I know that if there's a disability or an issue, this is still being managed. So some of the products we will sell are enablers. So that's the next stage. And that honestly is a stage we're still working on, right? The first metric, very clear. The second metric, how exactly one defines what works, what doesn't work. So we track it. We don't necessarily use it externally as a target, but we use it internally as a way to say, are we pushing ourselves around the solution?
Got it. In case of LeapFrog, they probably, the best measure is how good the company is performing, because their business itself is, by definition, making positive impacts. So if the company is very successful, then that is probably a perfect measure, or maybe, the most useful measure.
Yes. So we have we actually have a 4-dimensional range, right? So the financial results, it's called FIRM, it's a sort of framework, financial results, the impact results, the innovation results, and then the risk management, which include a number of the governance aspects, right? And ESG aspects of the business. And we do want to look at all of them together. And for us, innovation, is also around, therefore, the rate of change when you're serving this consumer set. What is your rate of change? How are you using technology to improve your cost structure, to improve the access on an ongoing basis? Are you thinking up of new products which can further enhance the value you're able to offer these emerging consumers now that you've reached them, right? Are you constantly pushing the boundaries? And frankly, quality innovation is great for a business because, you know, as an investor, part of it's the profit you're currently earning, and part of it is the potential profit pool you can access, driven off the new products, channels, services you're launching, or the reductions in your cost structures, which you can deliver to put yourself into a stronger position in the market. So we sort of look at all of these dimensions and use that to track how well we're doing.
Got it. Okay. How about you, Joe? How do you measure success in regards to ESG?
Well, I think it's part of our investment process that, you know, when we screen companies, and then when we do due diligence on companies, we really incorporate ESG due diligence into the things, right? So when you do your ESG due diligence, you will identify, you know, either at risk areas or areas where they're doing well, what are the areas for improvement, what are the areas where some of the things are non-compliant and all that. So when we then invest in a company, we will set a set of very explicit goals, right? I mean, we may not go to the extent of what LeapFrog does because we are not an impact fund, right? But we do set explicit ESG goals of areas of improvement or compliance by when, and when does these things get fixed, health and safety protocols, and all this objectives. And we track them actually at the board level and then at the IC level, right, of where we are going against these goals, right? And we do report them to our investors as well, so that they can measure whether what we say and what the company does, is it the same thing, right? So I mean, that's basically what we do. Of course, the goals would differ by industries and by companies and by the development phases of these companies. And the way that we define success is that, have we met or exceeded these goals? And these goals will be reviewed through time. And whenever we invest where there's a partner alongside us, right, where we are running the company, but there's let's say a 30-40% share partner alongside us, there's a family or conglomerate whatsoever, we make sure that under the shareholders agreement, right, we set this goals in mind as well, that they have to agree to these goals. That at the end of the day, I don't want to have piss off partners say, hey, I say that, you know, we have to get this thing up to a certain safety standard. It's going to cost $500,000. They don't come and complain and say that they want to take a shortcut, right? So I just want to make sure that among the shareholders, these goals are explicitly agreed on before we even sign the shareholders agreement.
Oh, that's pretty comprehensive. So yeah, I get we got the very interesting questions about the related to these issues. So he or she, the question is, how do you strike the balance between engagement and divestment? For example, if Archipelago comes into a situation that the cost of being ESG compliant is too high, do you try to fix or sell?
First of all, if you go in, then you find out that the cost of compliance is too high, is a bit late. So you have to first screen, right, to understand what the cost of compliance or what the cost of getting it to the specific thing that you want will be. And you have to take a measurement towards that. And if it's too costly, you have to walk away, right? I mean, you cannot invest in something that you fundamentally, like, this morning I was telling the students that, if you buy a chemical company and you find that the company is extraordinarily profitable, and a big part of the profits is because it has zero cost of treating waste chemicals, because its method of treating waste chemicals is dumping in the river, right? So how can you, and and that's the business model, right? So if you actually have to incorporate treating waste chemicals and the cost is so high, right? I mean, why would you even invest in the first place? But I do believe that a company that is not too far off and you have gotten in and you have managed to get it not only fully ESG compliant, but performing at a certain standard far above its industry, in terms of branding, in terms of reputation whatsoever, I do believe that there is ESG alpha to be had when you divest, right? Because look at it, now people are starting to be talking about ESG and all that. Can you imagine 5 to 7 years later, if something is flouting regulations, has a bad reputation, not treating employees fairly whatsoever, right? Getting fined by the regulator all the time and all that, what kind of buyer will buy from you? Right? You want to have an asset that where international class buyers, a Unilever, I mean, they were sending a whole full ESG team if they want to buy a company from you, right? Then you don't want to be stuck where the only people that you can potentially sell to are rogues, right? So yeah, I mean, there is an ESG alpha. So don't think about compliance as cost, right? To me, actually, compliance can be a growth area, and it actually increases their multiple when you sell.
Got it. But then, what if there's some, the uncertain the factors comes up later on after you make investments, and then the being compliant to those ESG factor becomes very expensive. And I think the other question is, can you access the business?
Yeah. Then what you're talking about, right, Shinya, is more an industry development and regulation development. Frankly, let's talk about private tuition in China, right? Right. I mean, but when such things happen, it affects the whole industry. Then, I mean, how it affects the whole industry because it's regulation driven. It affects the whole industry, and whether you can see whether that is investable or not investable. But most of this kind of risk should be sized up when you do your screening process.
Understood. Okay, there's a question, another question from the audience related to the screening. Do you, there's a E, S, and G factors, environment, the society and the governance. Do you have any focus in particular areas in terms of the screening process? I think this is a question for the Joe and Michael.
Sure. I mean, at some level, these become quite industry specific. So for us, to be honest, S and G have been more important than E. Not because E is not important, but because the environmental footprint of financial services is actually quite low at the first level, right? At the second level, we have some very clear guidelines around what our companies can lend to. But in general, if you're serving emerging consumers, emerging markets, you're not investing in coal-fired power plants, for example, right? So there isn't, most of our businesses, you go through the checklist, but the environmental issues have never been where the problems are in our current lines of activity. As we've looked at newer lines of activity, that E can become way more important, right? And even for ourselves, we're sort of trying to set ourselves can we have a higher benchmark on the E front within our portfolio and within our presence, because it's not that big a problem to go beyond the requirements on not doing harm to the environment if you're doing financial services and healthcare. S and G become very important, right? S and G become very important. The governance of financial services companies is critical, right? For the company, for ourselves, for the markets, the quality of governance, the quality of audit, ensuring that you're doing right by your stakeholders. You're often dependent, you're playing a role, an intermediary in a financial services chain. You're borrowing from large banks, you're lending to lower consumers, or you're getting money and deposits from people. So the governance of that and the risk management of that is very, very critical in our transactions. And the social aspects, are you actually serving the right consumers? Are you doing it in the right way? Are you treating your employees well? You often have large workforces in these companies. Not always. The tech companies are slightly different. It was also a very important group. So for us, S and G have proved to be where we've had to spend a lot more time. On E, in a few of our healthcare investments, which have been more recent, who have manufacturing plants, etc., then then the E becomes more challenging to review and diligence upfront. But even that is not often a big it's very manageable. It's management of the waste. It's thinking through how do you run your plant efficiently, which has been straightforward to do so far. I think that will change as we expand into newer sectors, but so far that's been the case for us.
Thank you. Joe, do you have any views?
No, I mean, no further insights in that. Michael is right. It really depends on the industry, and it really depends on the situation you're in, right? So I think, things like financial services or whatsoever, of course, is S&G that's the most important. But some situations where you have a partner in it, right? Where you have a partner in it, then the governance, shareholder issues, all these things should be transparent, worked out. Industry, manufacturing. We do have these businesses, and some of the things we are in, we do actually bring in technical experts, right, to come and not only do the commercial due diligence, but to look at the machines, but to look at the way that the chemicals are treated, look at the way the energy is derived and all that, to understand these aspects, right? But this is all proper due diligence, because this will have implications on the way you run the business. I wouldn't see this as just pure ESG issues, but it's just good investing.
Right. Yeah, I think at the bottom again, the good investments, very often or most likely associated with these, the good ESG factors. And then naturally, when you're looking for the good investments, you're thinking already about E, S, and G, but then it's probably not, very specific about, okay, you have to focus on E, you have to focus on S, and you have to focus on G, but then it's more holistic approach.
Yeah.
Got it. Thank you. Let's move to the next questions from the audience. This is a very interesting one. I'd love to hear Michael, but the impact investing, I think it has, it's associated with a lot of passion. And then you probably, before joining LeapFrog, I'm not 100% sure exactly what you did at the Khazanah, but then it may not be, the pure impact investing. And then why did you want to move from more traditional private equity space to this impact investment areas?
That's pretty, I guess, at some level, I was intrigued by the construct that, one could have a more leverage capital to do good, right? It's just as an interesting construct. It was an early stage of the industry, right? And even as, so if I go through my own career in McKinsey, I'd spent a lot of time just doing standard consulting contracts, but also working with governments on improving health facilities, creating appropriate ecosystems to improve employment opportunities in their markets. In Khazanah, because Khazanah is a sovereign fund, it does have a requirement or a mandate that there's some benefit to society from investments they make. Not necessarily as sharply defined as it is in impact investing. Right? So I do think that is what really intrigued me. Is there a way to use money in a structural fashion to do good? Right? And I do think at that stage also, if you go back to that period of time, 2007-8 is when I joined Khazanah, 12 is when I joined LeapFrog. And it was actually a part of the journey. There was a sense that just pure capitalism, without the some of the appropriate ESG and impact blinkers or mandates, has impacted people. So if you go back into old-fashioned companies, when families, a number of families still have that mindset, not all, right, depending upon where they came from. So the highest quality family-owned businesses would have an impact mindset to it, right? They would look at businesses and say, what we want to do is actually we want to do good. And we want to add value to our communities. We want to solve essential products, right? So I'd worked a lot with the Apollo group in India, run by Dr. Reddy, who came back from the US to set up the hospital chain. And the reason he came back to do that was to bring talent back into the country and solve a purpose bigger than himself, right? And I actually found that in conversations with a lot of entrepreneurs. A lot of entrepreneurs I've met, and the best of them are not thinking about how they get rich. They're thinking about how they build this business, which in their mind has a purpose, has an intent, right? And that's what they attract a lot of people towards. And I've seen that in my journeys across the region, right? In Philippines, in India, in Vietnam, companies are setting up businesses to be able to do good. But their sources of capital, institutional capital, intermediate capital, never had that ability because their mandates were always single-fold. Right? All I have to do is earn results. So they often found that misalignment would happen in what they wanted to get done, and then their key partners who would not necessarily share those goals. So we saw that as a very interesting space to begin to create pools of capital. Then direct those pools of capital very thoughtfully to areas which could have the highest impact. And commercially, those were interesting opportunities, but also you feel good if you're able to be successful in that. So interesting mix of getting both for yourself professionally, some social benefit on top of your creating commercial businesses.
Mm-hmm. Yeah, we definitely need more and more, the people like you, and then the companies like LeapFrog, and also, the Archipelago, so that, we're making the world, the better and better places. So maybe this is the last questions, and I find it's very interesting. The question is, we are seeing a group of men online right now. Yes, that's true. And then, so just wondering how involved are women in ESG and impact investing?
At Archipelago, half our staff are women. We are not an impact fund, but half of our staff, and we have 4 partners, one of which is a woman too. So it's they're involved. But I want to give you a caveat, right? A lot of there is actually a group of funds that I've met in the market who particularly want to focus on investing in women founders or women-run companies and all that. I think that you have to scratch a bit beneath the surface, rather than thinking that just because you invest in women founders, that's ESG compliant. Because we saw a company that had a female founder. I mean, it's a 12, 13-year-old company and all that, female founder whatsoever. But when we did our due diligence, yes, it's a woman founder, woman CEO running. She started the company and all that. But the policies within the company actually, we believe, discriminate against women. Let me give you one example. Right? Things like maternity leave. Maternity leave in this country is compulsory, 3 months maternity leave. But she insists that 1 month after giving birth, the employee has to come back to work, or else they go on no pay leave, which is not compliant. Because she herself, when she was having kids, because it's her business, that's what she did. So she forces all the female employees to adhere to that standards, right? So I mean, we have to sometimes not just see the headlines and scratch a bit beneath the surface.
Yeah,
we have quite a few women also in our team, it's so out of our 5 investment partners, 2 are women. So in Singapore, there are 2 partners, myself and another. The others are women. It's also been a little bit of a conscious effort by ourselves. So when I joined LeapFrog back in 2012 to set up Asia, the company had originally started in Africa. Before that, didn't really have a strong Asia presence, and I sort of joined them as a lead partner to set up Asia. we didn't have any senior women at all in the entire organization. It was a set of white South African males at start, right? And now the company is completely ethnically and gender diverse. So the senior team has a number of women, a general counsel, lead for Africa, lead for Southeast Asia, all women. And also from an ethnic point of view, very mixed. But I absolutely agree with Joe's point. There's no guarantee that a woman-run organization is necessarily woman-friendly. And sometimes it's their own defense mechanisms, right? Because they are women running the organization and just the context they're in, they're trying to prove that they're not, and they're overcorrecting in some ways, and you got to then work with them and sort of create the right balance to ensure that those companies also treat women. Sometimes it's a result we found of what they had to go through to become successful in a context where women didn't get any support. And I think we've also got to educate them that the world has changed. The world they had to go through is not necessarily the world they want to live on. And how do we make the the playing field more level and appropriate? So these are areas of work, and we've tried running this leadership programs across our setups, including for women leaders, to try building up those cohorts in emerging markets. We have found that that's very powerful, very powerful. Anyway.
Well, thank you very much for sharing. I'm happy to share that the next gen ESG programs almost half female students. And I'm hoping that maybe 5 years, 10 years from now, they will be part of this discussion panel. And then we can have an equal, 50-50 men and women, and then have the interesting dialogue. But maybe we should conclude our panel discussion today. I will give the microphone to Tiffany.
Thank you, Joe, Michael, and Shinya for the really insightful panel discussion. It's particularly interesting for me to learn that women-run companies are not necessarily women-friendly. And I'm really happy to hear all the efforts done by LeapFrog to improve diversity. So I can really see how engaged our audiences are, and from the quantity and quality of questions asked. I'm really sorry that we can't answer all the questions due to time constraint, but we hope you have greatly enjoyed the panel. So to our participants, we will be hosting another panel on the 3rd of October at 10 a.m. on how quantitative finance incorporate ESG. So sign up information will be available on our linking account, Generation Z Investment Club, next week. So thank you again for joining us on a Sunday morning, and see you. Take care.